So coming to domestic capital flows and investment trends in India, we've seen that there has been a lot of domestic, investment flows, which is somewhere kind of, taking away this whole dependency from foreign, investment flows, right? The amount of SIPs, to your point, on a monthly basis, which 500, 1,000 rupee SIPs which are happening, it's phenomenal. It's phenomenal. By number itself,
yes.
I would say it's a tectonic shift in terms of the wealth creation which is happening in India. So many capital markets activity which is happening right now as we speak. So much of wealth creation which we see coming in tier 2, tier 3 cities as well, right? So yeah, I mean, your view on some of these points would be really,
so it is
important for us to know,
yeah. So it is a very integral part of India's growth. So as we discussed earlier, what the developed world did in 150 to 200 years in terms of growing from lower income to upper income, we want to do in 60 years, which means that we need to grow at 3 times the pace that they did. Now, where does growth come from? Growth comes from labor input, capital input, total factor productivity, which is how many more workers are you throwing in, or you can have the same number of workers, you can throw in more robots, which is capital. In research, it could be databases. And then there is total factor productivity, which is that how well are you using technology, how you're well changing your processes to use labor and capital much more efficiently. Now, if you have to triple your growth rate compared to what the developed world did when they were at this stage, it is very hard to add more people, because that is demographics. There is a certain pace at which the population will grow. You can't do much about it. You can get more people involved, which is why I think improving female labor force participation is a very important part of our growth process. But you can't do that too much. Productivity growth will be faster. So if they were growing at say 0.5% a year, because they were at the productivity frontier, so they were kind of doing no innovations and then growing forward. India, by imitation, can grow say 1.5 or 2%. So adopt technology 3 to 4 times the pace at which they did it. But that still leaves a gap of about 4-5% of the growth that needs to be contributed by capital formation. When those countries were growing at 1.5-2%, capital formation was retained earnings. Right? So the company made profits, reinvested it, and grew. In India, that is not sufficient, because then it will grow too slowly. Now, the challenge is that if you make all of this capital formation debt, as we all know, it is unsustainable. I mean, it is very risky. If it works, of course, it creates wealth very rapidly, but the risk of failure becomes very high. So you need to have a good mix of equity and debt. Now, China bypassed it because by making sure that all of its financial services were state-owned. So if they gave a lot of debt to people, to businesses, if the business worked, the owner became a billionaire. If the business failed, the losses were socialized. So socialized losses, privatized gains. India cannot and should not do that, in my view. So where do you get risk capital from? Now, this is where SIPs play a very integral role. See, because if this money had been put in fixed deposits or any bank deposits, the only way they could have been deployed was through credit. Because the nature of capital doesn't change. Now, whether they are being missold, whether the people who are investing don't really know that equities are a dangerous asset class, they can be very volatile, is an observation. I think, that education, and if there is mis-selling happening, that needs to be curtailed. But the outcome from a macroeconomic perspective is that with $3.5 billion a month, which is $42 billion a year, you're talking about 1% of GDP worth of risk capital coming into the economy. And directly it cannot be deployed into companies. So what is happening is it is allowing business owners to exit, take out capital, create family offices, or allowing venture capital and private equity firms to make exits. So they say, some of them say brought in $1 billion 5-7 years back, and now they're taking out $2 billion. Now that seems like a loss, but remember that any capital you get has a cost. Venture capital is among the most expensive forms of equity. and we have been getting that. That has helped our growth.
Yeah.
But the very fact that these businesses or these venture investors are getting good exits is very positive, because it creates that feedback loop where they want to go and invest again. So this 1% of GDP of SIPs is actually creating a very fertile ecosystem on the equity risk capital market. Now, what happened in the first couple of years was that everyone was caught by surprise. Frankly, even today people don't understand how long this is going to last. But as the market started going up, like it happens in any market, that if there is too much demand for something and too little supply, prices go up. Once prices go up, then supply hits, because then the seller becomes interested. And this is exactly what is happening. So part of the reason that the markets have done nothing over the past 15 months is that there has been incredible amounts of supply. So IPOs, QIPs, block sales, and I don't think this supply is going to stop. In some ways, this is a natural, I would say, pressure release valve. So if markets fall a lot, the supply eases, and then the market gets pushed up again. So I think this is a significant amount of risk capital creation, which I think is a very unique and fundamental way in which India is different from how other countries have developed at this stage.
And what about bond market and private credit market in India? What's your view on that? Is it something that we can expect?
So for people like me, there are many people like me who get opportunities to advise the government on what to do. The last 10 years have been very challenging, because you can no longer repeat your advice, because if your advice is good, it gets implemented. So you have to work hard to come up with new ideas. One of the ideas which, when you are out of all ideas, is, we must develop the bond market. So for the last 25 years, this idea, when you gave to someone, they would note down diligently, yes, very important. But it's very hard to solve.
But what has been the challenge? I mean, of course, we would like to understand that. What has been the challenge? Because other markets have done it pretty.
I know. So, well, it's a classic problem of market creation, where you need to create demand and supply at the same time. So one of the reasons that investors don't get in is because these are illiquid markets. So below AA, so as someone was joking, to get money from the bond market, you have to prove that you don't need it. So you have to be a AAA or a PSU or an NBFC with asset to equity ratios which are 3 times or 4 times, not 10 times, before you can actually tap the bond market. What that means is that if you are, say, an A-rated or a B-rated corporate, or a BB rated corporate, when you go into the market, there's no buyer. Because if the buyer gets a bond, he can't sell it because there's no liquidity. So it is classic market formation, right? So demand and supply need to rise at the same time. And I believe that is very hard to solve. So how do you think of market makers? How do you create that infrastructure so that people have incentives for creating the market? More importantly, how do you allow people to make money making markets, and in the process, say, allow significant amounts of wealth to be created by the private sector for doing something very basic, because it is a very important service for the country to have over the medium term. There are many ways to solve this. So you can create allocations for pension funds. You can create allocation for insurance funds, for corporate bonds. You can, the interest rate derivatives. So these are, if you
and I'm sure it's been,
all of these suggestions have been made several times. Somehow we've not been able to solve it fully. So the size of the bond market is rising, so which is a good thing.
Yeah, yeah.
In fact, in the last 6 months, I think the bond markets have taken significant share from banks. As an Axis Bank employee, of course, I'm not very happy about that. But as a market observer, I think it's a very positive development. But still, I think that it's only for the high quality borrowers, and I think we need to deepen the market. Private credit, has its own limitations. I don't think it can scale like a bond market can. So I think it's important for us to get our act together to get liquidity into the bond market.
My last question to you, Neelkanth. What is your personal investment philosophy?
I doubt anyone can learn from that. I'm a very lazy investor.
I knew it.
So I don't take many decisions. So once in a while I act on my conviction. So like I bought some gold 2 years back. Again, it was 1 year too early, but it's now.
That was a good decision.
Yeah, it turned out to be a good decision.
And
for one year.
Asset class diversification too. I mean,
But so that was the reason. That was the reason, and I kind of felt that we are getting to a situation where this fiat currency risk and all of that will start coming through. I have felt that equity markets are too expensive.
True.
And so been parking away a lot of funds in arbitrage funds, or very basically low return but reasonably safe products, hoping that there will be a correction and I can buy. That doesn't happen, and I don't expect it will happen. It will be a deep correction anyway. I look at investments rather holistically. So suppose I'm thinking about the next 5 years. So if I'm working in financial services and a reasonable part of my payout is linked to the stock markets, because I work in an investment bank and it is linked to that, and part of it is ESOPs on the bank. When I think about allocations, I need to be aware that a lot of my income is also coming. So by definition, I keep some money in fixed income, because equities is where is kind of reasonable exposure. My explicit equity exposure may not be that high as I would have liked to, because I think that there is. So anyway, so I'm a very risk averse, very steady investor. I like doing my work, and there's not much time to spend on my own investments.
Yeah. So I can understand that. It's wealth management itself is a different subject altogether. It requires a lot of time.
Exactly.
Consumes a lot of time as well, and I'm sure bases your philosophy. I'm sure you're looking at a right amount of asset diversification and portfolio diversification, so which makes sense. But having said that, what a wonderful conversation, Neelkanth.
Thank you
so much. Thank you so much for so many insights and things that you've kind of spoken about, right from global Trump tariff to AI to GST, India's tag.